Good morning, everybody. We'll just give it a minute while people are still joining, and then we'll kick off properly. Right, I think it's 9:31. I know there's a couple of people still joining, but I think we will start there. So good morning, and thank you all for joining us. My name is Tom Reed. I'm an audit partner in the insurance team at BDO, and today I'm joined by my colleagues Nicola, who's a director in the governance, risk, and conduct team, Kiri Antoniades, who is in transaction services as an associate director, and we have Michael Whiteside, Claire Murray, and Ravi Prajapati from the tax team, who will be running through. So just briefly touching on some housekeeping points. Today's webinar is going to be recorded, and we will circulate the slides and recording after this webinar. All lines will be automatically muted throughout the webinar. And if you have any questions for us, please do submit your questions using the Q&A facility, which should be on your screens. So in terms of agenda, today we'll be covering the FCA regulatory outlook, highlighting any key points from the recently published business plan and progress with consumer duty implementation. We'll be looking at key trends in the insurance intermediary M&A space and what to expect and what to look out for. And then we'll be covering finally tax developments, any risks and opportunities, including R&D tax relief. So with that, over to you, Nicola.
Brill, thank you. So good morning, I'm Nicola Ball. I'm a director in our FS advisory practice, and I focus on governance and regulatory conduct matters in the insurance sector. And so in this first section, as Tom mentioned, I'm going to talk through some key areas on the FCA's agenda. So firstly, I'm going to provide an overview of relevant aspects from the recently published FCA business plan, followed by some key updates from the regulatory initiative grid published in February. And then I'm going to provide an update on progress firms should be making on the FCA's Consumer Duty of Care programme. And finally, I'm going to talk through a couple of hot topics, including the appointed representatives regime and the recently published guidance on how insurance firms can support customers in financial difficulty. So firstly, the FCA's business plan. So this year's business plan builds on last year's publication as a continuation of the FCA's 3-year strategy. And there are some key updates to reflect the governance legislative agenda and the changing economic environment. And there's a focus on the impact for consumers in financial difficulty. And the key themes for the 3-year strategy are and remain as sort of set out here on the left-hand side: reducing and preventing serious harm, setting and testing higher standards, and promoting competition and positive change. And under these themes, the FCA's described a total of 13 commitments in relation to these, with 4 of these being of greatest priority for the year ahead. And that's what I've set out on the right-hand side on this slide. So those being preparing financial services for the future. So the FCA is going to work with the Treasury to implement the new regulatory framework to address emerging harms more efficiently, putting customers' needs first, so to improve consumer protection and standards for all consumers and ensure support for struggling consumers. That remains a priority for the FCA. And reducing and preventing financial crime. So prioritising this will also help protect consumers, and particularly those consumers in sort of vulnerable circumstances, specifically who might be more susceptible to fraud. And that's also sort of supports the FCA's commitment in putting consumers' needs first. And then finally, that last kind of priority area is strengthening the UK's position in global wholesale markets. And that's to ensure that the UK continues to be seen as one of the leading global markets of choice, and strengthens the FCA's ability to respond to market volatility. And just moving on to the next slide, so I've just pulled out a couple of sort of key takeaways in relation to the business plan. So I think, we can expect to see the FCA setting and testing higher standards. It's clear that an important thread in the FCA's business plan is the FCA's flagship consumer regulation, the Consumer Duty, which comes into force at the end of July this year for new and existing products and services, and July next year for closed products. And, you know, just highlighting this, the FCA's set aside a budget for 5.3 million for successful embedding of the duty, with more staff focused on how the new regime is operating in practice and taking firms to task where weaknesses are identified. The current economic environment provides important context in this year's business plan, so it notes more focus on customers in financial difficulty, vulnerable customers, and the cost of living crisis. And other sort of areas just to note, so, you know, it sets out the introduction of a new gateway for firms approving financial promotions of unauthorised firms. It touches on further review of firms remaining within impact tolerances who are impacted by the operational resilience rules, focus on firms' financial resilience. As mentioned, there's also this focus on fraud prevention. So the FCA will use a combination of consumer awareness measures as well as intelligence and swift action to combat fraud. And to support the UK becoming a net zero financial centre, the FCA's ESG focus includes addressing misleading disclosures and also promotional materials, and they continue to work on sustainability disclosures. And the plan also focuses on embedding the new appointed representative regime, which I'll touch on a little later on in this webinar. And unsurprisingly, there's a sort of hefty policy focus on changes following the government's Edinburgh reforms, and they've got a budget of 12 million set aside for this. So there's significant policy agenda to rework EU regulation into appropriate UK regulation, as well as ambitious changes to increase UK investment and competitiveness. And I think it's clear that there's sort of increased resources for enforcement, which indicates that the FCA will take swift action where high risk activity threatens either the integrity of the financial system or consumer protection. And then just moving on to the next slide, I just wanted to touch on the regulatory initiatives grid. So the Financial Services Regulatory Initiative Forum published their latest edition of the Regulatory Initiative Grid at the end of February this year. And this sets out the sort of regulatory pipeline. And it's slightly different to the business plan in that it covers all regulators and also gives expected timelines and timeframes for publications and consultations. And it's there to support the industry to plan for initiatives that may impact on them over the next sort of 24 months. And it's quite a user-friendly document. So actually, you know, there's an interactive version, there's an Excel version, which means you can cut by regulator and sector, and it covers about 150 initiatives. It's published twice a year. This one was delayed from November to allow for changes that we've seen come in from the Edinburgh reforms. And you know, in totality, there's a small increase in the total number of initiatives since the last grid in May, but the overall pipeline has actually remained quite sort of stable, and the changes sort of broadly reflect policy-driven changes, but noting that these have the intention of ultimately reducing the burden on firms by simplifying and improving the regulatory framework. But again, important initiatives that are mentioned sort of remain a feature here, so operational resilience, ESG, the Edinburgh reforms, but importantly for this session as well, you know, conduct is a key sort of prominent feature here with a backdrop of the cost of living crisis and the incoming consumer duty requirements. So we touch on both of these in this session, and sort of moves me on to consumer duty, which is the area I wanted to touch on in a bit more detail. So I appreciate there is perhaps a little consumer duty webinar fatigue. So in this session, I focus on what firms should be prioritising now and how you can put in place appropriate governance and oversight procedures. So just in terms of what firms should be doing now, well, firms should be well underway with implementation. There was a requirement to have completed implementation plans by October last year, and the July deadlines this year are fast approaching. But there's recognition that the timeframes have been challenging to really allow for that sort of full strategic response, particularly where there might be technology changes required, and recent FCA comms have referred to substantive compliance. And they published a multi-firm review output on consumer duty implementation plans at the end of January this year, which really provides a good steer of the SAA's expectations and what firms should prioritise now to help them demonstrate engagement with the duty and compliance with the requirements. So if I just kind of talk through a few of those kind of key highlighted areas for attention. So effective prioritisation. So it's really important to ensure there's a clear basis for prioritising some areas of implementation ahead of others. So does your response evidence that you've addressed the biggest gaps and areas where there is risk of most harm? This may mean that plans are reprioritised in flight or resource diverted. And there is also recognition that not everything is likely to be fully in place or fully embedded from day one. So some aspects may be iterative, enhancements may be made with things like technology after implementation in July. So that's really important to signpost and think beyond the end of July. And linked to this, it's important that firms also kind of consider what the FCA's publish. So the FCA's Dear CEO portfolio letters on consumer duty set out kind of where they think kind of most kind of key focus areas should be, as well as kind of making sure that actually what you've set out in your plans joins up to your firm's priorities, risks, and other competing aspects that you might want to include. And embedding the substantive requirements. So you need to ensure that you can have evidence that you've considered, that you've thought about all the requirements and that you're taking action, and by when that action will be complete. And the consumer duty requirements shouldn't just be considered superficially, and firms shouldn't be overconfident on their view of existing arrangements. So you've really got to kick the tires to make sure that you meet the increased standards. And then working with other firms. So making sure that the plans focus on the information needs that need to be shared with other firms in the distribution chain, what information that you're reliant on, ensure there's a clear understanding and timetable of that engagement required with third parties, such as firms in the distribution chain and where firms outsource the delivery of services to other parties. And then sort of final point, just to note here, so deliverability. So you want to make sure that timelines and resources are reasonable, that risks and dependencies have been sufficiently identified and mitigated, that these areas that you really should be reviewing and challenged through the governance process to make sure that that focus remains as in place and that momentum is carried forward to ensure that plans are set for success and are being delivered as expected. So my steer is really to make sure that you thought about your story as a firm, so that you've got a clear articulation of how the consumer duty applies to you, the gap and delta of where you are and where you need to be compliant, and the actions that are going to be delivered to address the gaps. And that all should be evidenced through the governance framework with appropriate board engagement. So just touching on governance and oversight on the next slide. So I just wanted to pick up on this aspect from throughout the implementation period, but also beyond implementation. So I think it's really important to make sure that you've got an appropriate governance framework in place to evidence decision-making and agreement of actions for any areas of risks, as well as maintaining that oversight over the delivery of the implementation plan and good customer outcomes on an ongoing basis. The SCA have sort of said clearly that senior managers and boards are accountable for delivering good outcomes for consumers. The SCA want to see senior leaders and firms driving the changes needed to meet the standard. So therefore, considering how accountability of good customer outcomes is driven by senior management is important, for example, building those into statements of responsibility, etc. And firms should have appointed a consumer duty champion. So that's ideally an INED who ensures that the duty is discussed and raised and challenged at a senior level, and that the importance of the duty is recognised. Equally, second and third line should play an important part to provide their assessments of key risks, of effectiveness of controls and assurance around implementation, and that customer outcomes are considered on an ongoing basis as well. And as the duty is outcomes focused, it really relies on there being clear articulation of what good customer outcomes are and how they'll be measured, monitored and reported on. So in turn, to support that annual confirmation of compliance that the firm is meeting the requirements of the duty. So this is really driving a focus on enhancements to customer outcomes testing, MI and reporting. And without a doubt, the duty won't be a success without customer-centric culture in place, and therefore ensuring that there's a clear people and training strategy, and consideration of sort of leadership and people policies will be really important to success too. Now, just I mentioned I'd pick up on a couple of other hot topics very briefly. So just moving on to the next slide, I wanted to quickly highlight the updated appointed representative rules and guidance that came into force in December 2022, so last year. And these seek to improve in principals' oversight of their ARs and increase the information principals provide to the FCA and raise the standards and expectations. So principal firms are responsible for ensuring their appointed representatives comply with the rules, and the FCA want to see stronger oversight by principals to reduce harm caused through ARs, as they don't always see principals adequately overseeing the activities of their ARs. And the FCA have highlighted that where harm occurs, this is often as a result of aspects such as inadequate systems and controls and governance arrangements for onboarding AR, so with insufficient due diligence before appointing an AR, poor control and oversight of ARs on an ongoing basis, so the new requirements really call for a step change here, and often inadequate resourcing levels or skill sets for those onboarding or overseeing AR arrangements. And in light of this, they've introduced new requirements such as notification of new and existing ARs to the FCA, increased reporting on ARs, including complaints and revenue data, clearer expectations on onboarding, monitoring and offboarding of ARs, and annual reviews of ARs and annual self-assessment against requirements. And the FCA is really looking to test this in the coming year to make sure that firms are properly embedding the new rules across the AR regime, and they're sort of going to have more engagement on this topic. So firms can expect to see that increased engagement from the FCA as they appoint ARs, but also increased scrutiny as part of their ongoing supervision, sort of leveraging from some of the improved data that they'll have. And finally, just moving on to the last slide, I was just going to touch on the FCA's consultation paper that they issued in January this year on insurance guidance for the support of customers in financial difficulty. And this updates the equivalent and sort of previously issued finalised guidance in relation to COVID, but it's broader in scope and covers all customers in financial difficulty, regardless of the reason for being so. And it aims to deliver good outcomes to customers in financial difficulty by helping those customers maintain appropriate level of insurance that they can afford and reduce the risk that customers lose appropriate insurance cover that's important to them. So they don't want to see firms just cancelling insurance policies solely because of a non-payment without first considering actions to support customers who may be in financial difficulty. So the guidance sets out that firms should make customers aware of and help them to understand the support available to them in the event that they experience financial difficulty. So make sure you're easily contactable, that information setting this out is prominent. Firms should also be aware of indicators of financial difficulty, so missed payments, cancellation requests of key cover, customers not renewing key insurance, or where a customer contacts the firm about having financial difficulty. And firms should consider appropriate action that they might be able to take in response. So reassessing customer risk profiles, considering other products, adjusting covers, and really working with customers to avoid the need to cancel covers where it can be avoided. And equally considering appropriate fees and charges where you might ordinarily be kind of issuing these as part of business. And so if the guidance is kind of put into force, it will come into force in end of July. So sort of significantly aligning with those kind of customer consumer duty timeframes as well. So I'm going to leave it there. So, a lot to navigate and consider within the firm, but being engaged on these matters and thinking about the sort of key risks and priorities for you will be really beneficial and sort of position you well on these topics. I'm now going to hand over to Kiri, who's going to give us an update on insurance intermediary M&A space.
Thanks, Nicola. Good morning, everyone. So yeah, my name is Kiri. I'm Associate Director in the Transaction Services team here at BDO, specialising in financial services and particularly insurance. Our team undertake financial due diligence for both buyers and sellers, and we also provide vendor assist services and generally operate in the mid-market, so acting for both trade and private equity. So I see firsthand many of the trends and issues which I'm going to discuss. This is going to be a short update on M&A developments in the market, focusing on M&A activity, multiples, ownership concentration and consolidation in the market, and what impact this might have on M&A going forward. Next slide, please. So I'm sure you're all aware the intermediary market has undergone significant consolidation over the past 10 or so years, which has driven the M&A activity we've seen from both trade and PE-backed businesses. So using data from Merger Market, which is a data provider, we can see in the top left chart that the volume of deals in the UK intermediary market peaked in Q1 2021, with volumes over the past 2 years being a lot more subdued. This is for various reasons. Firstly, 2021 deal activity was exceptionally high. And there's probably a few factors driving this. One being COVID shutdown and associated uncertainty in 2020, which temporarily delayed transactions, which bounced back in H2 2020, Q1 2021. And also the anticipated changes to capital gains tax resulted in a number of retirement sales, leading to a big increase in transactions completed in the same period, i.e. Q1 2021 and H2 2020. And that also partly explains the subsequent reduction across the remainder of 2021 and 22, because a lot of the transactions that would have completed in this period were accelerated and completed earlier in Q1 2021. Another reason for the slowdown in transactions, or multiple reasons for the slowdown in transactions, is the level and pace of consolidation from the larger brokers. So a lot of the historical drivers of consolidation have somewhat changed over the past 18 months. So hardening market has eased the pressures on the cost base of some intermediaries and the need to generate scale and cost efficiencies. Hardening market with hardening rates also aids organic growth rather than brokers having to rely on M&A to achieve organic growth. And wider macroeconomic impact results in cheaper capital. So the cheaper capital to fund acquisitions is no longer available, and debt is harder to secure. And we're seeing some transactions that are actually falling through as a result of debt packages being harder to arrange. And I think probably one of the biggest drivers is the market isn't as fragmented as it once was. So good quality independent brokers and MJs are harder to come by. And as a result, a lot of the consolidators are having to look in other geographical markets for growth outside of the UK, particularly in Ireland and mainland Europe, where we're seeing a lot of interest. Although there has been a slowdown, the appetite for good quality business remains, and there's plenty of demand in the market for suitable investment opportunities from both corporate consolidators and institutional or private equity funded platforms. The insurance intermediary business model remains attractive for various reasons, whether that's providing predictable cash flows, recurring revenue, low capital expenditure, growth opportunities, as well as the market being relatively isolated from the wider macroeconomic cycles. So there remains significant levels of PE capital to be deployed. That's not really going anywhere, and they will continue to be a main driver of deal activity, both domestically and inbound. Although the shape of the market has somewhat changed, the fundamentals that have driven much of the transactional activity remain. I mean, the aging demographics throughout the intermediary channels, the increasing cost of complying with changing regulation and compliance all continue to influence business owners when considering potential sale. As I've mentioned previously, there's a diminishing supply of medium-sized targets in the UK, and domestic M&A is becoming more and more difficult as the imbalance between supply and demand continues to grow. Consolidators are having to look at smaller niche businesses which provide different challenging when completing deals. What we've seen, again, we're expecting to continue to see, is private equity houses buying for each other. And we've seen a lot of private equity exits and secondary and tertiary buyouts in the last few years, which we'll come on to shortly. This will drive further consolidation as these new investors look to buy and build before they in turn look to realise their investments in the next few years. So although the volumes have declined, we're expecting these lower volumes to continue. On the right-hand side, it shows some valuation multiples on both revenue and EBITDA. This is based on publicly disclosed deals over the last 10 years. I think one thing to caveat is to take this data with a pinch of salt, as it only reflects deals for which financial details were disclosed. So changes shown in multiples are generally due to lack of published data or certain outliers rather than real increases or decreases in multiples. However, what we're seeing and hearing on a day-to-day basis is that the broker and MJ asset prices have remained consistently high. Some of the smaller owner-managed businesses are generally trading 6 to 7 times EBITDA, increasing up to 10 to 12 times for larger, more scalable intermediaries of interest to consolidators. Generally, as a rule, the larger the business, the higher the multiples, obviously being exceptions. Buyers are generally looking to acquire businesses with particular specialisms and niches, not just purely for scale, and they're looking for sustainability and long-term growth prospects. And these businesses with more of a niche sometimes go for higher multiples, typically in the high teens. Given the imbalance of supply and demand in the market and the wide availability of PE money, it's currently a seller's market, which has meant multiples have held up despite the macroeconomic challenges we're seeing. But there is a risk that valuations may be negatively impacted as the increasing cost of capital and hardening market impact bids, particularly in MGAs, if capacity is restricted. Again, given it's a seller's market, not surprisingly, we're seeing a less aggressive approach in price chipping from buyers and a softer stance when negotiating net debt and normalised net working capital adjustments. Flick to the next slide, please. So our M&A team have put together a private company price index each quarter, where we collect data surrounding enterprise value multiples. This index effectively tracks the EV to EBITDA multiples paid by trade and PE buyers when purchasing UK companies. And this is market-wide, not just insurance intermediaries. This data is compared with historical data to identify key trends. And we can see in the PCPI data that there's been a softening in the marketplace following the peak in 2021, which I touched on previously. You can also see that companies and businesses are beginning to face headwinds and a lot of market challenges, with business owners fighting on multiple fronts. However, a lot of UK businesses are attracting strong interest from overseas buyers, partly driven by the weakening of the pound. So expecting to see continued interest from overseas buyers coming into the UK and looking to buy UK businesses. And again, on the right-hand side, you can see the impact of the capital gains tax previously discussed. It's quite clear with the increase in Q1 2021 and then the subsequent drop-off. If we just move on to the following slide, please. So this slide shows analysis of the top 50 UK brokers by ownership. The left-hand side is by revenue and the right-hand side is by number. The majority of revenue, 50%, is concentrated in the largest listed players, so 22% by number. The remainder of the market is dominated by private equity-backed businesses, 39% by revenue and 43% by number of brokers. And as I'm sure you're aware, there's relatively few independent players left, 35% by number, but only 10% by revenue. This picture is a result of significant consolidation in the market over the last 10 years, with relatively few independent businesses of scale remaining. What's also interesting is that over the past 5 years, since 2018, the number of top 50 brokers owned by PE has actually declined from 56% to 43% due to the consolidation, with consolidators acquiring other consolidators and exits from some PE houses, such as GRP being sold to Brown & Brown and Tysers, which is bought by AUB Group. On the right-hand side, the far right chart, we've analysed the PE-owned brokers, so 21 of the top 50, by their year of acquisition. 62% of investment has occurred since 2020, with a large proportion of these being secondary or tertiary buyouts, where private equity houses have sold to other PE houses or PE-backed portfolio businesses themselves. With the increase in the investment of PE capital, there's really not that much more in the mid-market for PE to buy, with the result that PE and PE-backed businesses are beginning to go international themselves, and we see that trend increasing. Based on a typical 5-year investment horizon for PE, the 62% of PE firms that were bought in the last 3 years may be looking for an exit between 2025 and 2027. Thank you, and I'll hand over to tax colleagues who can provide an update.
Thank you, Kerry. Hi, yes, I'm Michael Whiteside. I'm an Associate Tax Director in our insurance tax team. I'm going to talk a bit about corporation tax and most recent updates from the spring budget, as well as a couple of other just general updates on things that are going on in the CT space. My colleagues Claire and Ravi are going to cover employment taxes and R&D respectively, and they will follow after me. Next slide, please. So some of the key things that have come up in the spring statement to start with. So probably the most heavily trialled one related to capital allowances. So you may be aware that there was a super deduction in place between 21 and 2023, 100%, 130% upfront deduction on qualifying capital spend in that period. That came to an end at the end of March and has been replaced by 100% expense allowance, which is 100% upfront deduction for capital investment made since April 2023. And it relates to qualifying spend on normal plant and machinery type assets, so things like computers, fixtures and fittings, all that sort of stuff. We've also a 50% upfront deduction for special rate additions, which includes things like integral assets like lifts, air conditioning systems, that sort of thing. The annual investment allowance of 1 million has been extended. It sort of, to some extent, has a similar impact as the 100% upfront expense allowance, and that it is 100% upfront deduction, but it also applies to other companies, other entities as well as companies that get the expensing allowance, so partnerships, for example. So that was probably the main announcement from the spring statement. I suppose things that are relevant now and since the spring statement is the main rate of corporation tax has increased to 25% from April 2023 for large companies. That is companies with profits over £250,000. For smaller companies, those with profits below £50,000, they'll pay at 19% with a tapering rate between the two profit levels. Note that the profit levels are divided by the number of associated companies in your group. So if you've got a lot of associated companies in your group, obviously the thresholds are much lower for the rates to apply. Making tax digital for corporation tax is on the way. It's not before April 2026. We await more information on this. We're expecting things like more regular reporting, more retention of digital records, that sort of thing. So it's sort of a watching brief at the moment as we expect more information to come out. But like I say, not before April 2026. OECD Project Pillar 2. So this is a huge topic in tax. It's probably something that could take a whole webinar. So I'm just going to touch on it very lightly here. It is the global minimum tax rate of 15%, but it does only affect the largest businesses. So those with revenues over 750 million euros. So groups with revenues over 750 million euros will need to consider this and start thinking about it now. UK legislation is in draft, and the rules are expected to apply for periods beginning on or after 31 December 2023. So if you are a large business that exceed that threshold that I mentioned, certainly something you need to be considering, looking at the draft legislation, how it might apply to you. The rules are complex, so I won't go into any detail on them, but just if it is relevant to you, obviously it needs to be considered. Just switching to the right-hand side, IFRS 17 adoption. This is really for information. I appreciate the audience is brokers and intermediaries, but for risk-carrying life assurers and general insurers, it's of great interest. So I just thought I'd mention it. From a tax perspective, probably the main thing is how the transitional adjustment on transition from IFRS 4 to IFRS 17 is taxed. We know that it's 10 years spreading for life assurers, and the transitional adjustment comes in all in one in the period of adoption for general insurers. And I suppose the other thing that was that changed a lot in the budget, in the spring budget, when new things were announced, was actually R&D tax relief. But Ravi's going to cover that shortly, so I won't steal his thunder. Could I go to the next slide, please? You may be aware the Tax Administration and Maintenance Day was last week, 27th of April, where the government releases lots of information on consultations and calls for evidence, that sort of thing. There was quite a lot in there. There was things about potentially considering pre-population of income tax returns, for example, using information collected from third parties. From a corporation tax perspective, I suppose the one I pulled out here is the one that possibly most of interest. A consultation is going to be published during May on simplifying and updating the legislation I've listed there, so diverted profit tax, transfer pricing, permanent establishments. Obviously, we haven't, as at the time of writing, we haven't got that consultation yet, but obviously it will be something of interest to see when it is published. And finally, the final thing I was going to say in the context, because obviously Kiri's just covered M&A in the intermediary space, I thought I'd just mention a few things from a corporation tax perspective that are of interest on M&A deals and things we'd look at for due diligence. So some of the things, for example, we'd look at the effective tax rate, the compliance status, whether there's any ongoing inquiries, whether a future tax charge might crystallize due to an ongoing inquiry. We'd look at validity in the transfer tax attributes, particularly losses, other things like capital allowances that may transfer as well. And the only other one I pull out is one that we see quite a lot on the due diligence that we do on intermediaries in particular, is the compliance with the corporate criminal offence, which is the failure to prevent the facilitation of tax evasion, where groups need to have reasonable procedures in place in order to prevent that happening. So something that comes up quite a bit on our DD, so I thought I'd just mention it as well. That's what I was going to say. I appreciate it was a whistle-stop tour through C corporation tax points, but I will now pass over to Claire to talk about employment taxes. Thank you.
Good morning, I'm Claire Murray. I'm a director in BDO's Global Employer Services team. I specialise in employment taxes and work very closely alongside my colleagues who work on expatriate tax matters and also share plans and incentives. From an employment tax perspective, there wasn't that much that was exciting in the spring statement, so I'm actually going to look at something a little bit more topical around year-end reporting obligations for employers, because whilst it's spring and it's a new tax year, in the world of employment taxes, actually it means that there's rather than looking forward, there's a period of time looking backwards to gather information and think about what's happened in the tax year, which has just finished, in order to complete a number of reporting obligations which come up over the next few months. And that's around sort of short-term business visitors for those who are part of got some non-UK businesses within the group, employment-related securities, and also expense and benefits, and deciding whether they should be on the PLMD or PSA. And as with most reporting requirements, obviously early consideration and thinking, starting to gather the information, really does help better compliance and supporting and good tax runs. And obviously underpinning that is good processes in place during the year, which hopefully is regulated businesses. That's something which is one of your sort of skills, to make sure that you have all the sort of proper processes and controls in place to do that and underpin compliance. But as part of that data gathering, it's always good to reflect on, actually how easy was that process? Do we, could there be changes to the process controls to make improvements and simplify things for the year ahead? And I think a lot of people just think, oh, it's just a lot of employer returns that we need to file, but actually it can be quite complex. First of all, there's a number of different reporting obligations, but also with employee matters, typically there are a number of stakeholders involved, which is where things sometimes go awry, because often different people are reporting different aspects of employment income, expenses, benefits, the shares. So it might be payroll, it might be finance, tax, or HR, or someone else again, or it might be a combination of those. So it's kind of about working closely together and ensuring that nothing falls down any cracks in between teams, which is something we see quite frequently when we go in and talk to our clients. And just picking up also on what Kiri was talking about in terms of M&A activity, if there have been sort of some corporate changes in the year, it's also about thinking what that means at year end. You know, in terms of employment-related securities, it may well be there's been a bit more activity and more to capture, and it might be a bit more complex than perhaps in other years. But even around expense and benefits is actually understanding what happened in the transaction, what's happened to the pay-as-you-earn scheme and the employees, and what does that actually mean about who is responsible for reporting what year end. So, for example, in some circumstances, depending how deals have been structured, it may be that actually at year end there's only one pay LMD required, even though that actually might be two employments. You know, perhaps if employees have transferred from one business to another under sort of 2P arrangements, but typically from the PSA, each business will normally need to report its benefits it provided during the year. So it's just, again, thinking about that in plenty of time to be really clear about who is responsible for what. And just briefly touching, I guess, on each of those areas, so I've got a few minutes, so I don't want to go into any detail, but for short-term business visitors, that's about the non-UK employees coming into the UK to work. And just because they're not paid from the UK doesn't mean that a UK company may not have pay-as-you-earn reporting obligations. And typically it will have a reporting obligation unless there's been some kind of agreement with HMRC, which might be a short-term business visitor agreement or a special annual payroll. And then that means, well, with the SDBB agreement, it means that rather than having to operate pay-as-you-earn, it requires information to be provided to HMRC. And really, the longer people are in the UK, the more information which needs to be submitted to HMRC. But it's just worth noting that it doesn't cover all individuals. So they don't come from countries where there are tax treaties. It doesn't cover non-resident directors. And UK employees or overseas-based employees of UK branches. So it's just really thinking about who is it that's been travelling and what have you got in place to capture that, and also think about if they had anything else other than just cash pay, such expense and benefits, which might filter through to the other reporting requirements. The PLMDs, they changed this year. It's the first year ever that paper forms can't be used for PLMDs or for amended PLMDs if there have been mistakes. So they now do need to go into HMRC in electronic format. Obviously, a lot of employers will have been doing that over the last few years anyway. You can use HMRC's sort of systems for doing up to 500 PLMDs, but for large employers, they will need to use commercial software to do this. And it's about making sure you actually understand what needs to go in. Have there been any changes in benefits during the year which need to be picked up? And actually, are they going to go on the PLMD, or actually can they be included in the PAYE settlement agreement, which I'll touch on briefly in a minute. Another area which we often see mistakes in is where benefits have been payrolled during the year, but the Class 1A national insurance is still reported on and then paid via the P11DB at year end, so that rounds by the 19th of July, so it goes in on the 6th of July. And that's sometimes an area that we see quite frequently, where the Class 1A on those payroll benefits isn't actually captured properly. The other deadline on the 6th of July is the employment-related securities filing. And again, new for this year is that there are some mandatory fields. So now more information is needed around national insurance numbers and pay-as-you-earn references. So again, it's just making sure that those time has been built in to capture that additional information. And obviously, you're thinking about who is reporting. So again, in a group situation, who is actually reporting any employment-related securities that have been provided to employees, and that doesn't necessarily mean it's always a formal plan. It could be more ad hoc arrangements. And again, if there's been a transaction, it's quite it may well be that there's a bit more to report, and early consideration is always helpful. And then finally, I just want to touch on the PSA. I've put in there 31st July as a deadline. That's because HMRC typically asks for the computations to be sent in by them, but it's not actually a statutory deadline. The deadline is actually really just making the payment on the 19th of October. But obviously, it's good to start the process early, and so that you can really fully think about exemptions that might apply and what actually does need to be reported. But before we ever get there, there is a deadline also for PSAs around the 6th of July, which is the deadline for making amendments to the scope agreed with HMRC in terms of what can be included within it. So again, as part of the PLMD process, it's really important to consider, does the scope currently cover everything that it needs to cover, and does actually anything further need to be agreed with HMRC before those PLMDs are submitted? And a kind of common area in that respect is the perhaps benefits, changes to working patterns. People are now travelling from home, and it might just be considered ordinary commuting. How are those costs being picked up, and who's going to bear the tax on them? Is it going to be through POA settlement agreement, or is it already being taxed through some other means? So that was a little whistle-stop tour through compliance, and I'm going to hand over to Ravi, who's going to cover R&D.
Thank you, Claire. Good morning, everyone. I'm Ravi Prajapati. I'm Associate Director in R&D Tax team. I'm part of BDO's very large 100 people strong R&D Tax team nationally, which is divided into different industry sectors, focusing on based on our experiences in the field. My background is I've been software developer for over 8 years, and into R&D Tax 7 years ago, and I've been supporting mainly clients in financial service and in fintech department. Next slide, please. So I'm going to talk about R&D tax credits, and it's a very important aspect of corporation tax element. Generally, companies are very focused on the changes, and recently there has been plenty of them. So worth noting them as I talk to them. So first of all, it is to be noted that the large companies will receive a net of 15% of tax credit from 1st of April 23, and that is over the line. So the credits are received on the pre-tax earnings. For smaller businesses, their rates have gone down from 33.4% to 18.6%. But for R&D intensive businesses, where 40% of qualifying expenditure qualifies of the total spend qualifies for R&D purposes, they receive a higher rate of 27% going forward. For many of you might know what R&D for tax purposes is, but for those of you who are new to this topic, the R&D tax credits is incentive, government incentive to promote businesses to take more risk and advance their offerings in terms of science or technology through enhancing their systems and making them more capable of doing complex functional aspects. And in terms of what qualifies now from 1st of April 23, there are more areas that might qualify, which is your investment in going to the cloud and making more big data leverage and enhancements to the systems, and appreciable improvement of sales platform and CRMs. More costs qualify from 1st of April 23. Previously, the bulk of costs that qualified was staff costs and externally provided workers. But going forward, there are more software licenses costs like your cloud spend, your cloud storage and cloud computing will also come into picture as a qualifying activity. In terms of overseas costs, the deadline for their exclusion has been extended in the spring budget, and they are still going to be qualifying up to 1st of April 2024. In terms of additional changes, the pure mathematics will also be a qualifying activity. The government has extended the R&D definition to include projects which are underpinned by mathematical advances to be qualifying in nature. So it will be worth having a look, considering projects where there is mathematical modeling involved that advances the knowledge in the industry and is a part of your R&D projects. There's more focus on the quality of the descriptions that is disclosed to HMRC, and this is to stop fraud and abuse of this of the regime, and for that everything is going digital from the 1st of August this year, and the R&D will have to be submitted via an additional information form going forward from 1st of August. There are more changes on the notification requirements as well, and that has to be taken into consideration if you have not been claiming R&D tax relief before. As part of BDO, we have got R&D benchmarking toolkit, which might give you a fresh pair of eyes to rethink your R&D claims over the past. If you it compares similar industry and similar size companies to benchmark them across your peers, and gives you more insight on areas that you might be claiming or you might need to start thinking about based on the changes that have come. With that, I hand over to Tom for closing remarks.
Thank you, Ravi. So just as we wrap up, we do have a couple of questions which we're happy to revert on now. But if anybody should have any further questions, either do submit through the Q&A or reach out to the individuals when we circulate the slides and the recording afterwards. We will include contact details. So if you would rather reach out directly, please do so. So probably the questions raised have a very similar tone. So I will revert to Nicola, or divert the questions to Nicola. And there is just a question around customers in financial difficulty that's been raised. And I think Nicola is just going to pick up and respond now.
Yeah, Brill. That's a really good question. So the question that's been posed is, do I have a view, or do we have a view on how the sort of guidance around customers in financial difficulty applies when a customer can't afford to immediately pay an excess? And it isn't the focus of the consultation that's come through, and it may be more prominent in the finalised guidance that we're expecting by end of July. But I think the expectation, it is mentioned in the paper, so it refers to other actions which may be appropriate based on the circumstances. So they talk about a few other levers that firms might have to be able to support customers, and one of those being allowing customers to pay excesses flexibly over an extended period. So I think if firms can do so, then the expectations that are set out in the paper I referred to, as well as the sort of broader consumer duty expectations and delivering good customer outcomes as a new principle as part of that, I think the expectations is firms will be able to have that flexibility, and it's also been called through in good practice, and other potential levers that firms might have are things like accelerating claim payouts for those customers who might be more in need of receiving the outcomes on their claims quicker. So really is that there is this expectation of higher sort of raised standards and adapting to customers' circumstances, and really the spotlight is given the sort of backdrop that we have with the cost of living crisis, for example. So the FCA is really wanting firms to work together to support customers on this and make sure they get good outcomes. The other thing I was just going to signpost, which is slightly aside, but I know there's also more guidance expected around premium finance. So the tailored support guidance that we had through COVID, the aspects of that pick up on premium finance, so things like forbearance, there's going to be a follow-up consultation to broaden that out beyond COVID as well. So that is due to be published in the consultation on that is H1 of 2023. So that's, picks up on consumer credit, mortgages, lending, but premium finance falls within that. So another one to look out for, which I think should be coming relatively soon as well.
Thanks, Nicola, and I think that answered the question very fully. So thank you. So I was conscious of time and everybody's diaries. I think if there are any further questions, as I said earlier, please do submit to us directly, and we're more than happy to respond. And also, as you said at the beginning, a recording of this will be circulated. And if there are any further questions that come out when you see the slides or anything, please do again ask the question. So finally, I would just like to thank the team for presenting today, and also to you for joining us for this webinar. And I hope you have a good rest of the day. Thank you very much.